ING Group just reported second quarter earnings. Underlying pre-tax profit came in at €2.02 billion, which beat estimates. Joining us now from Amsterdam is Koos Timmermans, the CFO of ING. Koos, very good to have you with us as always on the occasion of your results. Tell us a little bit about what has driven the performance in the second quarter.
Yeah, good morning, Anna. I think overall what has driven performance is the increase in the amount of customers. We have 400,000 increase in primary customers, so that brings our total to 12 million, where we have a target of 14 million 2 years from now. The total amount of customers is now 38 million in 13 different countries, and we've seen growth a bit across the board. Germany, Australia, Poland, Spain. And overall, those clients, they did more business with us, so we got 14 billion worth more of loans, of which 8 billion in retail, 6 billion in wholesale, at approximately the same margin, because we have seen our net interest margin stay more or less stable at around 151 basis points. And then, in a relatively credit benign environment, if you keep your cost a bit low, at a 52.3 cost income, that brings us the profit number you just mentioned, which is a return on our equity of around 10.4%. So overall, I think good results and more or less based on more client business.
You talk about net interest margin there being stable, Koos. What would it take to drive margins higher? Is it just a rise in policy rates that you need to enable that to happen?
Well, I think overall, if you would see short-term rates like up to the 3 years move from more negative territory to positive, that's certainly something which would help. On the other hand, what you do see, and that is what right now, customer lending, I don't see margins deteriorating on that side. So if we would get a bit of more benefit of higher rates for our savings money, that we can invest it a bit more profitably, that would certainly help.
Can you tell me a bit about what you're expecting to see on cost income? I see the cost income ratio, 56.1% for the second quarter. Is that higher than you want it to be? And what explains that number?
Yeah, overall what we see is our cost income is a bit choppy, but that is because regulatory costs are basically paid in Q4 and in Q1. But net what we want to see is a cost income below the 55 on a rolling average basis for the whole year, and that is something which we will accomplish. But please realize we do have an investment year. For instance, if I look at it, we are investing in a new partnership with AXA, and that is to make sure that we can sell more insurance. We are investing also, like this quarter, what we did is we fully integrated our record bank, that is a Belgian bank, into ING Belgium, and the next step will be the whole Belgian bank run on the Dutch platform. So we are still making quite a lot of investments. So last year and this year are years of investments, and that will start to pay off at a certain moment. So we expect our cost income in 2019 and 20 to move more south.
So there's a lot of investment going on. You've also built up a decent capital base, 14.1% CET1 ratio then, Koos. What's your strategy for returning cash to shareholders? Some investors maybe were disappointed by the dividend payout ratio last time around.
Yeah, I think overall our capital position looks good, so it's 14.1%, and what we are doing is we are accumulating our dividend over the first 3 quarters. We are accumulating basically the same amount as what we paid last year, and always in the fourth quarter we then see can we pay something extra. But we got to be a bit careful on that, because we still have Basel IV coming, so that means you do need to save some money for that as well over time, and also see that we are growing as a bank. I mean, our loan growth is quite steep, and we are making a decent return on it. So the balance between returning it to the shareholder, but also keeping enough ammunition for growth, as well as making sure that we keep the regulation happy, Basel IV, that's where we are continuously working with. So that is why we keep a more or less stable but very steadily growing dividend and don't do something excessive.
Okay, nothing excessive. Can I ask you finally, Koos, about trade tensions? I was just speaking to the boss of Siemens and getting a number of CEO and CFO perspectives on this. Some have described your client base as relatively exposed to global trade. Are you seeing any impact as yet? Are you fearful that trade tensions will impact your business?
If you actually look at the impact right now, realistically, then realize that if you take the EU 28, where we have most of our client base, we are exporting roughly 6% to the US. And if you look at that in Netherlands, where we also have a large client base, it's also around 6%. So that means, like, if there is then sanctions on particular goods, it's not that you immediately notice it. So yes, you look into the client base and see who are the exporters, who are local transporters, but it's difficult to find something immediately already where you say, like, hey, here's a concern. I think right now we are far more looking at the secondary effects of it, and the secondary effects is if everybody is talking about it and it dilutes confidence, then it will dilute a bit of investment appetite, and that might have an impact on your loan growth. So that is at the moment more on our forefront of our thinking.